Welcome, everyone. We're pleased to be here with Venus Jenkins, from the CEO and co-founder of ChargeNet Stations. Welcome, Venus.
Thank you so much.
I'm Wade Martin, the director of the Institute for Innovation and Entrepreneurship, and this is a continuation of our podcast series on how to start up. So, Venus, just to start off with a little bit of a background, I know that you were a co-founder, and ChargeNet Station has been in existence a few years now. Could you provide just a very brief background on the evolution and how you ended up with the headquarters in Long Beach, California?
Yeah, happy to share that. The origin story of ChargeNet. I started my career at Southern California Edison, which is the second largest utility in California. And around 2014, I started to see a transition take place. And now I'm thinking about it, we're recording this first week of 2025. Almost a decade ago, the energy transition, those two words didn't exist. At that point, we were just seeing the early onset of electric cars. And being at utility, I was also seeing the disruption in the monopoly of a utility on the generation side as well. The solar penetration, the wind penetration was also taking place. So around that time, I got my first EV, 2014-ish, yes, or 2016 actually. And anything that could go wrong did go wrong. I was an early adopter, but being in California, traffic is so bad. It was for the carpooling sticker. And like I said, anything that could go wrong did go wrong. So I looked at that as a major pain point, and the incoming data points that I was seeing at the utility. So I paired up those, a problem to solve, and energy transition in the mix, and that's how we came up with ChargeNet Stations. It's a distributed energy resource platform, but primarily we focused on fast EV charging coupled with battery storage and solar. Those are the distributed assets. But we didn't stop there. We looked at that there is going to be a paradigm shift, which it already has happened, that this is not going to be necessarily the gas station model, it's going to be gas station plus something. So for us who had, and my two other co-founders as well, we had a decent amount of EV utilization experience. We looked at the market segment that would make the most sense from Americans' perspective. And that's how we came up with building infrastructure at fast food restaurants. So that's sort of the origin story of ChargeNet Stations.
Great. Now, when you started, was Long Beach always the goal to have the headquarters here, or is that something that evolved?
It definitely evolved. When we started this company, it was the early onset of COVID year, now almost 5 years ago, or four and a half, 5 years ago. We were all remote. So we started out as all remote, and our headquarter or mailbox was in San Diego. So, and as the story goes, it was a mailbox dedicated to us at a church, because we didn't really start out of a garage or anything like that. But yeah, we started in San Diego. And then as we went through our ups and downs over the last 4 some years, about 2 years ago, I stepped in the role as CEO. Before that, I was leading operations and infrastructure. So I said, there's got to be some perk of being a CEO. And since I lived in Long Beach, I'm like, and we're still all remote, it just made sense from just documentation and just having a central point. And So I decided Long Beach it is.
I guess not so surprisingly, that's a very common occurrence where the headquarters is where the CEO is. So
Yeah.
that's true of many different companies.
I mean, I don't want to all say that, yes, there's definitely that primary reason, but then there are a number of secondary reasons too. The ecosystem evolved in the last 5 years in Long Beach too. This being the Long Beach Incubator, Cal State Long Beach, some renewed focus on clean energy support, clean energy company support. So and the other big reason behind Long Beach was the Port of Long Beach, the accessibility and the speed to getting our supply chain in a timely manner. It just, all the pieces sort of fit together, and it sits sort of in the middle. And I jokingly tell everybody, oh, Irvine, that's half an hour. Oh, LA is half an hour. Long Beach has a very strategic location where everything is within half an hour to an hour.
Mm-hmm.
So all those reasons also played into the decision.
Great. Now, as you mentioned, you started with this partnership with fast food or quick service restaurants, where you would be able to grow and build your infrastructure along with theirs. So that early business model, is that something you also is a benefit to the fast food restaurants? Sort of what's in it for them? Do you split the revenue? Do you generate power that they can use? Those kind of things.
Yeah, from the very early onset, the piece that I mentioned in my first response was that we started out as a software company. I feel like every company in California starts out as a software company. And initially we were just going to do a proof of concept at one of the Taco Bell locations, prove it out that by integrating these 3 different energy resources and then having a very strategic location will actually provide this large beachhead market for the infra side and then us for software side. So the front end of the software, what I mean by that is it is killing multiple birds with one stone. Meaning this is where the drive-through experience of 10 minutes, instead of sitting in the drive-through, now you are charging your car and ordering your food. So that's the front end of the software. And then we add the loyalty programs, we add incentives. For example, we had a holiday coupon, get 20% off on charging and a free burrito. So from front end perspective, it made sense that fast food restaurants are good strategic real estate locations. Now the restaurant owners, they are getting multiple benefits too. We either offer them a net revenue share for letting them use use their parking spots for a long period of time. We do sign long site leases because it sort of follows the same solar model that you need 10 to 20 year site control. So in return, they get either net revenue share if they're bullish on EV charging growth, or they get a rental payment per parking spot. But those are, I would say, basic benefits. The more attractive benefits to them is that we are bringing a new customer that's not taken into account of their customer profile. So we have done quite detailed analysis of what their current revenue looks like, what is that conversion rate from the early data set. Right now we're seeing a very high conversion rate, basically close to 50%. So any customer that's coming to charge at the fast food restaurant, half of them are ordering food. And that's a very high conversion rate. And very quickly you can calculate how many charges did you have, what percentage went inside, what's the ticket size, and you can see that benefit is material benefit to the fast food restaurant owners.
Great. When you look at the charging in 10 minutes, say, for the average that you're using. What does that convert to in the range extension for the vehicle? Is this level 3 charging? And
Yeah, in the past, I used to say 100 miles in 10 minutes or less, but the charging technology is also going through this change. It's improving quite rapidly. So as we're building new sites, we're deploying 160 to 200 kilowatt chargers. Now they can do almost 200 miles in 12 minutes or less. But then this is the the fine print where you get into it. It depends on your battery state of charge curve, and you should charge all the way 100%, all that. But I'll keep it to the soundbite of 100 miles in 10 minutes or less.
Wow. Now, is this efficiency in the charge, that's the software you bring to the...
So the software is unique in itself. We have multiple patents on our software. The charger software, this may be a contrarian view right here, but I consider that a bit more a commodity because it's open source platform, OCPP, and there are quite a lot of other charging software companies that do a great job. What we are doing is less focused on the charger software and more so on the distributed energy platform in the background, or call it the back end. The front end is all the customer facing. What the customer is going to order food, what the charges are, what are incentives. When we have these flex alert days when the AC is running, if you're charging your car, can we incentivize them to charge at a different hour? All those things is the front end. The back end, I would say, is where the fun happens. And that's where I truly get excited about. Because when you bring battery storage in the mix, you have created this flexible platform. And battery is a key, and I think CPUC, California Public Utility Commission, CEC, California Energy Commission, and many other states also recognize that if you want to meet the goal of 100% renewable power, battery has a huge role to play. So this is in a roundabout way of when you have solar, battery storage, and bidirectional chargers, now you can write software, or you can create an algorithm that's looking at the energy pricing signal. And currently our software is looking at 5-minute intervals. It comes from the meter data. Rather than going into very, very details, it's basically looking at how to maximize the revenue potential for the asset owner. So a very specific example I would give is just a basics example that everybody understands. We charge the battery storage at a low peak rate. So California energy market is a dynamic energy pricing market. Even for residential, it's time of use hours. You're not paying one flat fee. It depends on when the sun is shining, you pay low. When the sun is not shining, your peaker power plants, natural gas power plants are kicking in, the price goes up. So we take advantage of that, and that's our arbitrage opportunity. The battery charges at low peak hours. And in a lot of cases, we now have plenty of solar, and almost there are times in the day where the energy pricing is going negative. So practically, the battery storage is charging from the grid at a very low rate. And now when you have your evening dinner rush hour, that's when the prices go up. In some cases, they triple and quadruple. And just to keep numbers, just to give you guys a perspective of numbers, we could charge our battery storage as low as, call it 20 cents per kilowatt hour. During the peak hours, when the car is coming to charge, like 6 p.m. dinner time, the rates could be as high as $1.10 per kilowatt hour. So you can see that this is a massive arbitrage opportunity. The delta between those two is huge. And that's why battery plays a key role. So that's what the software is doing. It's continuously looking at what is the energy pricing, and that's just one component of it. There are a whole host of other programs through utilities, through CSULB market, trading market, where they're aggregating the assets. If we have a brownout or a blackout or a brownout, battery storage, the next generation of battery storage will have black start capability, and that adds resilience to the grid. So you don't really need the grid. You can charge 5 cars or so without the grid. All those are revenue streams unlocked by this flexible software platform. Very long answer, but that's what the software is doing in the background, and that's what gets me excited that we are heading in that direction of a very flexible energy platform.
So you mentioned that you started as a software company. But does that mean that now you're also developing hardware, or are you purchasing from a third party and adapting it to your use?
We're hardware agnostic. The funny story behind this major pivot, we still have software. Software is a key component of this this distributed platform to work. But the reality hit us like 6 months into developing our MVP, and that the assets don't exist. The assets don't exist in this specific configuration. So we could develop all the software in the world, but it will not have any hardware, any physical infrastructure to deploy on. And if you look at one of the really older stories from, I guess, 80s, the Microsoft Office, that Bill Gates was just waiting for PCs to become affordable, and they knew what they were holding on to it. Once PCs became available, then it just blew up. So they didn't take on the hardware, but ours is not as simple as PCs. There's safety pieces to it. These are high voltage wires, so it's not as straightforward. And then we're also working with utilities, the interconnection. So assets didn't exist, and in a typical startup fashion, we had to go solve that problem as well. So now it's a full platform where we develop infrastructure and layer it with our software.
Whenever a startup gets ready to raise funds or launch their business, there's always a discussion about product market fit and trying to understand that and convince investors that you understand that. So how have you seen your product market fit evolve as this sort of software company evolving into multidimensional software, hardware, arbitrage with the energy market, and with fast food restaurants?
Product market fit, product is that it's an energy platform where we have infra coupled with software, so a turnkey solution. Market is, you could look at it from many different angles. You could look at it as, are you trying to sell it in fast food market? Are you doing EVs only, or is this energy market? And some investors may not like to hear it. In the early days, we were very much selling it as, this is an energy software play. And then I still look at it as an energy market. What has emerged to me in the last, I would say, 18 months, because now we have operational assets and we're seeing the flexibility come into play. And with the utilities allowing us to export to the grid, everything we sort of envisioned in the early days 5 years ago is slowly getting unlocked. So So in retrospect, it was a $0 billion market. Now, as the market is unlocking, it's hard to put a number. Why I say that is because it would require you to pick your lane and decide which way you want to go, because energy market is, I don't like throwing out these numbers, but it's like $1 trillion plus market. Mm-hmm. So you have to pick your lane, and if we pick our lane of EV charging, that's still about $127 billion market. So to answer your question, product market fit, I would say in the early days, I don't think we had a clear answer. We were strictly a software play, but the infrastructure didn't exist. Now the infra exists. I believe this is a new market, and our current product of a turnkey solution fits in this new distributed energy market that is now growing even faster than we initially imagined. So to answer your question in a long roundabout way, is the product market fit after building multiple sites has given us a level of confidence that primarily it's an infrastructure play, and then secondarily it's going to be software play.
Now, what you see with the charging network, the infrastructure, you have companies like Tesla has their own sites, Rivian's developing their sites, ChargePoint or Blink, they all have sites. Now, is your competitive advantage over these? Is it the partnerships? Is it the technology, the software?
Yeah. Investor, what does your competitor 4x4 looks like? Our biggest differentiator is hyper focus on one market segment. When we look at Tesla, their core product is not charging, and we heard the whole supercharging team being fired, and then the typical drama cycle that goes with Tesla. Yes. But looking at Blink, ChargePoint, EVgo, or other competitors, they have been market agnostic, and what that translates into, and I've used pretty much all of those networks as well, is a lack of customer experience. And that's what I and ChargeNet, we have always focused on, that our biggest differentiator is hyper-focus on a market segment that addresses the largest American population. And that's 80 to 100 million Americans eat at fast food restaurants every day. Nothing to brag about, but that's the reality. And when we know what our customer type is, what they're ordering, what their times are, what these fast foods are cookie cutter designs, and they all look like drive-thru going around them and a building in the middle. We have standardized design, we have front end integrated with the menus, we have the most competitive pricing because we have battery storage in the mix. So when we put all the pieces together, our primary focus is customer experience. You could add all the bells and whistles, but at the end of the day, the customer is looking at, when I plug in, the charger works, and I want to order food, I'm sitting in my car, and my food is delivered, so it's multiple errands in one stop. And that product offering I haven't seen anywhere. You could look at Tesla chargers, who I consider have the highest uptime. The experience is good, but in most cases, Tesla chargers are like quarter a mile away, at the end of a mall parking lot. So by the time you go to a store and back, they start sending you notifications. You will be charged $1 a minute if you don't get to your car. So customer experience is what I hyper focus on, a market segment that addresses the largest American population and customer experience.
Excellent. Now, in looking at the whole ecosystem for electric vehicles, there's been a lot of discussion about whether or not the infrastructure is there to support them, whether or not there's, given the waste generated by batteries, the rare earth minerals, etc. The subsidies from the government, and is this a sector of the economy? Obviously, with your business, you're betting on this sector to be successful. Do you see that these will eventually, things like the subsidies go away, but it'll be competitive enough with the other parts of the automotive industry that those won't matter? You're seeing that advances in scale taking care of that.
It's a very interesting question, because there is that reality that ITC, the investment tax credits, and certain subsidies on EVs, and a combination of regulatory push, policies, all of these pieces together, they have helped our market quite a bit, this market segment. So a couple of thoughts on that. The first, from infrastructure perspective, we're nowhere near what I would call gas station parity, that where people could feel that yes, there is a charging station wherever I go, there will be a charging station, and so there's still a huge lift on the infrastructure side. Now, to your main point, can they stand on their own? A large part of renewable industry can stand on its own. Solar, I think now you could take solar anywhere. It's so price competitive. Natural gas beat coal. Solar is beating natural gas. You could look at short-term futures, long-term. Solar is reliable, and you have production curves for 20 some years. So that's a proven model that we can now take it to the bank, and it's an investable grade asset, and it works. Now, the emerging markets, where we are looking at battery storage with rare minerals, EVs, EV charging infrastructure, there are many things to be said about that. I do think we still need supportive policy to continue the growth we are seeing. But at the same time, I also recognize that we are past the inflection point. A decade ago, when I got my first EV, nobody knew what EV was. The chargers, more than half of them broken. All were slow chargers, nothing like that. But now, just in the last 4 years or so, literally in front of my own eyes, almost every other neighbor has one EV. And yes, you could say we live in a bubble, Long Beach, California, where EV adoption is pretty high. But at the same time, I look at international markets too. Even if the growth and the policy support we may not get over the next 4 years, it's not going to go back. It's not a trend that I see reversing. I look at international markets, they're going to move with or without US, and they're already moving. So can they stand on their own? I will say that we're not going to see a trend reversing, but it may slow down if we don't have policy support in the US. I don't see that internationally, that's going to move forward.
A lot of people sort of forget the history where these subsidies for all types of industries that are new and emerging, new technology, that they exist, and many subsidies still exist in the oil and gas sector.
Absolutely.
So it is interesting how the debate goes, and you miss out on the acknowledgement of some of those other more hidden subsidies than the obvious $7,500 off on your car price or something.
at the same time, I also look at it as, take some pride in creating an industry where U.S. was still the leader. We may not be the leader in the next 4 years, but creating this industry, this market growth, and proving it to the rest of the world that this is real business, and this is job creation. And yes, the benefit is you're cleaning up your environment, but the primary focus are these are profitable businesses, these are bringing new jobs, these are cleaning up your communities. So we should take some pride in that and proved it out to the rest of the world. This adoption is real this time.
And a lot of people, earlier you mentioned brownouts, blackouts, and there's always a debate about upgrading the grid and all of this. So from your perspective, when people argue, oh, we can't have 80% of the auto market in electric because the grid won't support it, what's your response to people that think the grid can't support an electric car market?
I'll give a Californian view, and then I was also told recently, look, that not every state has California sunshine. Yes. So I have to keep the colder states in perspective too. So from California perspective, right now, I just looked at the statistic just a few days ago that we had 98 days. I don't know if you guys saw it too. The 98 days of 100% renewable energy. Try wrapping your head around that, and that's way ahead of the target that we have set for California. And this is competitive pricing. We're currently seeing days where the energy pricing is going negative. So what does that mean when somebody says, oh, energy is less than the market price? Basically, we're producing more energy than the demand is. We're supplying more than the demand is. So you have to curtail it. So basically, you're producing more, but the demand is less. So to answer your question, in California, I think we will be okay.
Yes.
The challenge is less so about energy production. The challenge is energy delivery at the right time, matching the demand and supply curve. And that mismatch comes because we are producing this abundance of solar and wind, primarily solar in the daytime, and at night when you have exceeded, or during the daytime you have exceeded the demand, and at nighttime you're below the demand. So you need some transition to store the extra energy, and once again that comes to battery storage. And that's where a big push has been. A lot more incentives with the NEM 3 being passed. Basically, they reduce the incentives for solar and increase the incentives for battery storage. Because same thing, they want to have more battery storage deployed. So when the energy pricing is going down, which is basically saying that we're producing more and now the utility will have to curtail, you take that excess energy and store it in battery storage and deploy it at the right time. So California will be okay. Yes, that means because now you're bringing a lot more variability into the grid. It's not you just turn on and off the power plant. When you're bringing in distributed energy resources, you do need to upgrade the grid that can support electrons in both directions, and then also the software and complexity that comes with it. From that perspective, yes, we will need investment in grid, but from generation, production perspective, I think California will be okay. Now, looking at some of the other states, like Texas, whenever they have a little freeze, it just, the blame goes in all directions. And then when you take Northeast into account, all that. I mean, they're no doubt it's going to be difficult to meet 100% renewable because not having access to sunshine or wind, need to look at other resources. And I wouldn't say I'm the expert to address colder regions.
One thing about expanding a startup or scaling a startup is access to venture capital or investors and finance. The last year or two has undoubtedly been a challenge with EV investors. Are you finding that your model, that you're finding a group that is interested in clean energy, in clean tech as an investment strategy, and they're starting to be more receptive at the moment and better understand the evolution of the industry?
Actually, on the contrary, I think they are. It's been difficult all around for venture funds to raise their third, fourth round of capital, LPs not getting their returns, and then founders and the companies not having access to capital as they are just right at the precipice of an exponential growth. So looking around, I think this is, once again, macroeconomists said it many different ways. There haven't been IPOs, there haven't been liquidity. Stock market returns have been 23%. Why would you invest in higher risk ventures? Why invest in venture models when you're getting such high returns in the stock market? So when you take all those different pieces, I actually think the investments have regressed in clean energy and climate tech. And some takeaways from this has been that, I think venture market, now VC funds fully recognize this too. It used to be scale at any cost, growth at any cost. And that I don't see anymore. In the last 18 months or so, venture funds are looking for more profitable companies, or just at the break-even point, or showing profit in the next 6 to 8 months. But that's also a challenge when you need capital to grow to become profitable. It's like catch-22. Like it's been very difficult. So the way I look at it is like, couple of thoughts on that. Liquidity in the market for startups and small companies have been very difficult because interest rates are high, so cost of capital is high. Stock market is doing exceptionally well, so that means most of the capital is going there. No exits, and so there isn't liquidity. So it's like this reinforcing loop over and over. So I have some hopes in the next few months that there will be some break in the interest rates and some IPOs and some capital liquidity coming through. But the second thought, which I really look at it, is when I started this company with my other two co-founders, I was the engineer on the team, the infrastructure engineer, was not familiar with capital markets and interest rate. I mean, I knew the basics of it, but when you become a CEO and you have to do capital raise, then you really learn all this. But where I'm going with this is, when I started ChargeNet, I truly started it as that this is a pain point, this is a good idea, this is going to be a profitable business. Not that we're going to raise more and more capital to make it look bigger and bigger, which is nice. I mean, every founder wants to close those rounds. And more so in the last, I would say 8 months or so, that's been what I've been more and more focused on, that look, every business cannot just continue to survive, with the exception of like big Ubers and the world, Amazons of the world, that they don't have to show profit for a while. But from business perspective, you have to have customers, you have to have paying customers, and you have to be able to pay your people salaries who are working really hard for you day in, day out. And you have to make some profit that you could reinvest in the company and grow the company organically that way. So those are some just basic fundamentals that I think have forever existed, and nobody likes to talk about it because it's not sexy business to talk about, because it's more fun to talk about IRRs and how the valuation is, pre-money, post-money. I mean, at some point, yeah, I may bring all that back, but right now, and in the last 8 months, it's been how do we get more paying customers, and how do we get more infra built, and how do we make it more profitable.
So you're at a stage in scaling where the traction you're getting is keeping everything operational and afloat, and then to take the next jump.
Yeah, and that's the really big challenge, because this last year I really focused on the sales side. Let's what we define sales as contracts with fast food, these restaurant owners, because that's a pretty difficult market to break into too. It's not a straightforward, here's your 4 parking spots for 20 years and off you go. Those are complex real estate transactions and hadn't been done before, and it was quite difficult for us to get past 4 sites. So the last year I primarily focused on how do we get these long-term contracts signed. So it took us a long time, but we got through it, and now we have close to 140 contracts signed, and that's about $100 million in the pipeline. So that sounds great, right? So I focused on building the contract pipeline, and it's not just contract pipeline, it's contracted revenue. Now I need to convert this contracted revenue into actual revenue. And so that's my current stage is, okay, I'm sitting on a pile of these sites that are ready to be developed. And a parallel capital needs to come in, both from scaling the team and scaling the infrastructure as well. But if we slow down the growth, we have 140 contracts. If we have to be self-sustaining, then we're looking at building 10 sites in 2025. So that's also a huge balancing act for me. Okay, we're sitting on a large pipeline, but if we are not able to raise this large capital stack, then our growth is a lot smaller too. But maybe that's the way it's gonna go. If there is no liquidity in the market, we grow slowly and organically.
Right. So you, just to diverge a little bit, you mentioned starting off as the engineer of the group, of the founding team, then evolving into the CEO, and I think so during this startup cycle, building the company, you also went to get your MBA and get that financial business side expertise to keep the startup alive and growing. Is that?
It's interesting because I got my MBA actually right before starting ChargeNet, because I used to work for this large corporation, and when you work for a large corporation, your world is very much limited to just that corporation, and the world around it is power plants owned by SCE and the headquarters and all that. And then you step outside and you go to a pretty big business school, and then suddenly you're exposed to many, many different industries, biotech, tech, software, different energy markets. And it's like one of those things once you go to MBA and you meet all these people and they inspire you, and the professors who are solving world economic forums and doing macro analysis of the world banks, and I'm like, okay, I think I have a little more to offer. And I would definitely say MBA gave me the confidence that I have enough in me to go start a company. And the other thing was a couple of the first investors also came from B school, my classmates, who believed in me, and they're still our investors supporting me. And I would say that experience is everything that I expected and then some.
See, listeners, it pays to develop that network in your business school.
Yes.
Particularly at MIT. But that all sounds great. One of the things that really impresses me about ChargeNet and the way it's evolved is your philosophy behind a company and how it should be operated. Many people in class or in their conversations heard about the idea of people, planet, profit, and the idea of balancing not just the success of the business, but also the success with the employees, with the community, and particularly in the automotive sector, with the environment, the natural environment. Can you say a little bit about that philosophy and how it imbues all of ChargeNet? Is that something from the beginning with your co-founders that was behind everything? Or has this evolved, and we're particularly excited that such a company is in Long Beach?
You know, there's so much to be said about that. After being in this role, it's like you just start thinking about, okay, revenue, net income, free cash flows, this, that. But when we really started, and this is a little bit funny, and maybe I tell maybe my MBA brainwashed me a little bit, because they have this large engraved saying, I don't remember the whole thing, but the 3 keywords are like, be a principal leader. And before starting the company, which was literally 6 months after I graduated, I wrote a manifesto, be a principal leader. So I wrote 5 things, and the first few things were, look, I'm not gonna start another app company that just is like use, nothing against that, but it's like, you know, if you throw a trash bag here versus there, your carbon footprint is less. I wanted to make a macro level impact. So my dent on the universe is going to be, how can I offset a large carbon footprint? So that was one of the number ones. I also look for, if I'm not going to start a company, I'm going to join an early startup, what the board looks like, diversity mattered to me. And then there was a third one that I wanted to focus on, very specific sector, primarily energy, because that's where I could bring value as well. And then 4th and 5th were a little bit superficial. Like, I want to stay in California, and I want to go to Boston somewhere. And I also have 2 little kids, so I wanted to be a role model and all. So I wrote that, and I sat on it a few months, digested it, did my research, and that's sort of how I met my co-founders. Because I reached out to 4 people who were working in similar areas, and we sort of hit it off. So that was how we came up with the idea of ChargeNet, different markets. And then the number 2 thing, we don't usually talk about it. All 3 of us had our own driving force. My driving force was actually, believe it or not, it's Long Beach. I have lived here for now almost 15 years. Yeah, 15 years. I had my kids here, and the thing that really got to me was when I had my second baby, and she was 6 months old, and she couldn't breathe and was getting almost like asthma attacks. And we lived in a decent neighborhood. And then my nephew, who's a couple of years older than her, he developed asthma. My sister's daughter also had asthma. And we all live in decent neighborhoods. It's not like we live right by 710 corridor. So that started to bother me, that, okay, let's peel the layers. The reality is pollution doesn't know borders or boundaries. Yeah, we don't live by 710 corridor. That doesn't mean somehow you would be spared from the heavy particulate and the cancer molecules that call the cancer alley. And that was my North Star. And I said, when we were building this company, the day I would consider its success when we have assets, infrastructure in 710 corridor, disadvantaged low-income communities. Now we have 2 contracts. So, and they are Atlantic, one on Atlantic and one in another community right there. So that was my North Star. My other 2 co-founders had similar ones. And what we noticed when we were looking at our market segment, these fast food restaurants also had the benefit of that these are in low income and disadvantaged communities. So while everybody was focused on market agnostic and affluent neighborhoods, Tesla chargers, nice fancy malls and neighborhoods, there wasn't much support for low income disadvantaged communities. Why would there be? Number one question I would get from investors is like, how many people in low income disadvantaged communities drive EVs? And I'm like, so let's not build anything there by that definition. So this is me just peeling all the layers, how we have slowly built into it. And the last thing I would say is, building a startup, building a company, it is not an easy task. I do not wish that upon anyone unless you want to suffer for a very, very long time and you have a very big North Star. I have a team that's ride or die team, and it's 50% women, 50% men, very diverse team, and I wouldn't be here without them. We have gone through many, many difficult times. Recently, when we did our holiday celebration, one of the consultants joined. He's like, you have a very unique culture. This is not me patting myself on the back, but it's just, I'm very proud of my employees too, yes. But my team, because he said, when there is an issue, it's not a software team issue or a construction team or CEO issue. It's everybody. Everybody jumps in and says, okay, I'm going to make the call. I'll check the data. I'll go be on the site. Everybody jumps in. And yes, we're small, so we can contain and maintain that culture. We'll see how it goes. I would like to keep that culture. But that's the last piece that adds to the fabric of ChargeNet. My North Star of building in disadvantaged low-income communities, reducing the carbon footprint, and my team that believes in the same mission. So we are all a principal leader.
That's great. Definitely having charging stations where people in the low-income neighborhoods can see that, hey, an EV is an option for me, would be an important element to that development. Finally, not to use up all of your time, but where do you see the opportunities in the future as you continue to grow your business and you look at the automotive sector, and it really does need further disruption, I believe. Do you think that is in batteries? Do you think that is in just having more scale there, more opportunities, more charging facilities, but having faster charging where you can get to 10 minutes for a full charge instead of 30 minutes on level 3 or something?
There is technology, I don't want to call it improvement because it's not incremental improvement. What we are truly seeing an overly used word, disruption. Battery storage, different chemistries. Which one? Right now, lithium ion is the market standard, the industry standard. But that doesn't mean lithium ion is going to continue to be the industry standard. There's tons and tons of research, academic research, even companies that are building scalable batteries, solid state batteries. So that's one side of it. And then you peel that layer, there's another one which is, okay, where the raw materials coming from, and then you're looking at salt and see all that stuff. So that's hardware side. And I could go on and on, because like I said, there's innovation happening, that type of innovation I haven't seen on the hardware side. What I mean by that is that just like the way oil trades in the market, futures, long-term, short-term, different pricing structure. And to some extent you could say CSULB market already does that, the energy trading market, but it's happening only at utility scale. And you could say virtual power plants are a version of that. I'm looking at it as this entire marketplace evolving into, you can trade electrons like retail traders on Robinhood are doing with, penny stocks or dollar stocks. That to me is maybe so far in the future, that type of marketplace being built, because at the end of the day, it's still based on a physical asset. The electrons have to be delivered if they're buying and selling somewhere. And this seems like such a high-level concept, but an example I could give is when a specific example, we took a wind tour in Palm Springs, and this gentleman who was giving the tour, he said, "Oh, now we have a battery storage plant because we have to curtail when wind is producing, and the battery storage stores it, but they use it, they may not use it." He wasn't very clear on what's happening to that excess power. So I look at those as like, those are wasted opportunities. There's curtailment happening all over the world, not just limited to California. And that is multi-billion-dollar market, which I know people are scratching their heads. How do you transfer physical electrons from one place to another place and then monetize those electrons? So that is exciting to me, that having that really live, dynamic marketplace to trade electrons.
That does sound exciting, and I look forward to you solving the problem.
We'll get there someday.
Well, thank you very much for taking the time to join us and to share your wisdom and your vision. And for those of you looking at what it takes to be an entrepreneur, founder, you have to persevere, as they always say, but also be able to see the opportunities and have that vision. So thank you very much, Venus.
Thank you for the opportunity.